Good morning and welcome back to Almus Market Mornings, your daily dose of global financial updates. Weaker data from the US prompted a US dollar sell off, with traders betting heavily on the risk sentiment. Euro rallied more than 1% on Friday as US labor market looks more shaky. Is it a shift in narrative? We had been seeing a relatively stronger US economy, but as yields come down and the natural tightening in financial conditions, which Powell talked about, eases, will consumption bounce back? Lots of questions. Good morning, JK. What are your thoughts on the recent data out of the US and talk to us about the narratives you expect to play out in the future?
Good morning, Swaraj. Yeah, I think the non-farm payroll report for which the market was waiting the whole of week, ignoring many other indicators, did not disappoint in terms of volatility. Not only did the headline growth number of 150,000 miss the consensus forecast of, consensus forecast by 30,000, it was also accompanied by a downward revision to previous month, and unexpected rise of 1/10 in jobless rate, to 3.9%. Also, the hourly wages on a month-on-month basis was lower as well. The average monthly payroll gain over the last 3 months has slowed down to 204,000, and after peaking at 2021 708,000, obviously that was an aberration post-pandemic recovery. But that's nearing the average monthly gain of 183,000 in the decade leading up to the pandemic. So that's very significant. We are basically going closer to the pre-pandemic level. That's very significant. Now, following the non-farm payroll, we had also the ISM services, which came at 3-month low on the US side. So services side contracting is significant as far as US is concerned, because services form a major part of their economy. Importantly, the prices paid component as well as the unemployment, or rather the employment component, were lower in the report. So that actually added to the bearishness on the yields. Now, if you look at the market's reaction, now the traders now expect Fed policy to change, or rather go up only 10% probability in January from 30%, which was there before the employment report. Also, rate features reflecting a better than even chance of Fed cut in May 2024, which is also accompanied by several more cuts in the next year. And this is from what they were expecting to be in July onwards. Now, the other side, Fed members like Boskin and Kashkari have reacted very cautiously to the weak jobs report and wanted to wait for the inflation number that's coming up. Now, signs of markets were actually on the euphoric side, and there were several superlatives. Signs of slowdown, which has been a big boost to the fixed income market, has seen the bond yields fall sharply. 2-year yield has fallen by 17 basis points, 10-year by 27 basis points, 30-year by 24 basis points on the day. And it was also helped by US Treasury, which has announced last week about much lower borrowing for the longer tenor. German 10-year yields have fallen by 20 basis points, and UK by a whopping 26 basis points on the last week. So which means that, overall, everywhere, this has happened despite the central banks owing to maintain higher for longer rates. As I said, across Wall Street, superlatives piled up, with S&P 500 climbing almost 1%, notching its best week of 2023. The VAX seeing its biggest weekly plunge since December 2021. Two-year yields down by 15 basis points, as I already said. And dollar did slid the most since July. Oil also sank to 81 as the risk premium for the Israel-Hamas war diminished. So equity markets rose across countries, and we did see even the global composite index rising by more than 1%. Now, what question you posed is also the question that I have in mind, whether these rallies will last. Now, while policymakers will be pleased to see economy slowing down, they may not be happy with the sharp fall in the yield which they have been pointing to as doing their job so far. Now, besides, the sharp rise in stock market prices also eases the financial conditions and can eventually lead to more demand, more consumption, and inflation being once again supported. So normally when economy slows down, stocks should fall and bond prices should rise or yield should fall. But now both rallying, which will in my view, keep Fed's vigil, and market expectations of earlier cut will be misplaced unless inflation also falls sharply. I feel if central banks are glued to the inflation data in the coming weeks, unless they see it consistently easing, their policy rates will continue to remain high despite what the markets are expecting. On the currencies, dollar index falling more than 1% last week, tracking yields closely, is perhaps more sustainable than the stocks in my view. There has been a negative bias building up against the dollar for several months, and that's sustained despite sharp slowdown seen in other economies like Europe and UK. And what we have seen since July is only a correction to the sharp fall in dollar index we have seen since September last, from 114.75 to 99.59, and that has seen a strong resistance above 107 now. If the dollar index were to fall below 450 now, I think it will be a sign that we are once again moving towards the previous low. On a medium-term basis, U.S. fiscal challenges remain. It keeps increasing steadily with war in Ukraine and Middle East, getting U.S. funds, and also the political stalemate in the U.S., which is coming up very often, is not helping the long-term investor sentiment. So the bias on the dollar is definitely negative on a structural basis. This is notwithstanding what happens to the stocks and the bond yields. And whenever there is a risk of dollar will stall, whenever the risk eases, you will have the dollar falling. So for a very short term, dollar should consolidate its losses this week ahead of US inflation figures that will come on next Tuesday. Strong resistance for euro is seen at 1.08, I mean, and support for dollar index at 104.70. And as I said, break up these levels will give momentum to the dollar's fall to the previous lows. Also, let's keep an eye on the Middle East because the report says Palestinian death toll in the war has reached 9,450, and that's not going to be viewed easily by the other countries who are fighting Israel. And some reports which I read indicate that Iran has been testing grounds with some proxy wars, and so all is not cool there. And we should be alert to any sudden eruption of violence from the other side as well. So risk is not really going to be sustained on a benign note for too long. On the rupee side, we did see a slightly wider range in the last few days, helped by dollar index easing somewhat. And on Friday, we saw the dollar index pushing the dollar rupee also lower towards 83.11. Now, what's important for the rupee is that the flows from FIs continue to be on the negative side, even in November, although it's not as high as it was seen in September and October. Yeah, we're still early in the month, so we are not very very sure how the coming days will go. But in the lead up to the elections, even the stocks are seeing subdued performance compared to other markets globally. Valuation concerns, or their FI's negative approach to stocks, these are impacting. So the view on the rupee would be based on whether we see large flows which will not be absorbed by central bank. So if that is not there, it is well supported. And on the upside, obviously, RBI will be protecting rupee from falling to new lows. What can possibly happen, keeping in mind the dollar index, which is likely to fall much more, is that the rupee remaining stable in a range will correct its RER, which is currently valued over by 5%. So that is what I expect. I think 83 figure and 83.30 should hold. 80 to 90 break can invite some stop losses and fall towards 80 to 70. Also remember that despite trading at near all-time lows, exporters are not forthcoming to sell big because they are put off by strong fall in the premiums in the last few days. We will just see how the premiums react from today onwards, if basing on fall in the US yield. All said and done, this will be a reactive week to the big moves that we have seen in the last week, and then next big figure to watch out will be obviously inflation from UK as well as USA. Thank you.
Thank you, JK. We saw a sharp dollar fall because of the non-farm payroll missing the headlines, as well as the ISM services coming in lower, indicating that at least the services side of the economy, which was earlier somewhat resilient, is now slowing. After all this data, market is now pricing a US rate cut in May 2024. Yields have fallen sharply, and not just in US but even in other countries. And the break of 10450 on dollar index can trigger further downside. For rupee, of course, the factors remain whether we see large flows and whether or not these flows are absorbed by the central bank. But somewhat it should remain in a stable range, as if it remains in a stable range, the RER itself will correct. Geopolitics is a tricky subject to understand, and to simplify it, we have a geopolitics expert, Professor Nalapat, who is also the UNESCO Peace Chair, for a webinar on 7th November between 5 p.m. to 6 p.m. The link will be in the description. So do tune in on 7th of November. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.